Picture money as a river. It never sits still. It just changes hands. Most people step into that river with a small cup, trying to scoop a little for themselves. They swipe credit cards, finance cars, take on student loans, and slowly get pulled downstream. Their debt takes money out of their pockets. The wealthy step into the same river. But they don't bring a cup. They bring a pipeline. They don't fear debt. They study it. They price it. And they turn it into an employee that works 24/7. Because here's the rule. Debt must put more cash in your pocket than it takes out. If it doesn't, it's a liability. If it does, it's leverage. Here are 5 ways the wealthy use borrowed money to multiply wealth. 1. Borrow the product, not the cash. Smart operators don't always borrow money. They borrow time. Imagine a wholesaler importing $100,000 worth of goods. Instead of paying up front, they negotiate 60-day payment terms. That means they receive the inventory, sell it, collect the cash, and only then pay the supplier. Their own capital stays free. This is called trade credit, and it quietly powers global commerce. Companies like Amazon use versions of this strategy at massive scale. The principle is simple. If someone else will front the goods, your cash can fund growth instead of sitting frozen. 2. Turn real estate into a recycling machine. Wealthy investors don't just buy property. They buy undervalued property. Imagine purchasing a duplex for $500,000. You put 20% down and invest in renovations. After improvements, the property is worth $700,000. Now you refinance based on the new value. You pull out your original capital, sometimes even more, while still owning the building. Rent pays the mortgage. Your money moves to the next deal. Buy. Improve. Refinance. Repeat. Debt becomes a tool to recycle equity instead of trapping it. 3. Scale a proven business with borrowed money. Let's say a business is already profitable. Most owners wait years to grow using retained earnings. Wealthy founders move faster. They issue bonds or take strategic loans at low interest, then invest in expansion, hiring staff, increasing marketing, improving operations. If they borrow at 4% and reinvest at 12%, they keep the spread. That's exactly what companies like Apple and Microsoft do, even while sitting on billions in cash. Why? Because the cost of debt is often cheaper than the return on opportunity. Used correctly, debt compresses decades of growth into a few focused years. 4. Amplify gains carefully. Debt magnifies outcomes. In markets, leverage allows investors to control more assets than their own capital alone would allow. That amplification can double gains or double losses. Sophisticated investors hedge risk, diversify positions, and only use leverage when probabilities are strongly in their favor. The lesson isn't to gamble. The lesson is this: leverage is powerful. Use it only when you understand the downside. 5. Keep cash invested. Let cheap debt do the work. Sometimes the smartest move isn't paying cash. It's keeping cash invested. Mark Zuckerberg once took out an extremely low-interest mortgage despite being able to pay cash. Why? Because if your mortgage costs 3% and your investments earn 8 to 10%, your money works harder invested than locked in a house. Debt, in this case, preserves liquidity and maximizes returns. But there's a catch. You must actually invest the difference. not spend it. Debt is a lever. Debt isn't good or bad. It's a lever. Used recklessly, it drowns households in stress and payments. Used strategically, it multiplies time, effort, and capital. The wealthy measure cash flow before they sign. They insure against risk. They exit bad deals quickly. They borrow to buy assets. They avoid borrowing for liabilities. They make sure every dollar of debt produces more dollars in return. So the question isn't, is debt dangerous? The question is this debt putting money into my pocket, or taking it out? Choose wisely. Because the same river that drowns the careless can power your engine upstream.